Right. Good day, ladies and gentlemen. Yeah, you're welcome to the masterclass once again. Today, I'll be talking on one of the monetary policy instruments of the central bank, which is open market operation, popularly known as OMO. So, the open market operations are some of the monetary policy instruments of the central bank of a nation in order to control the economy, to bring the economy to a particular desire. So especially when it comes to money supply in the economy, so to ensure that there's a control on inflation and there's a general growth in the economy. So the central bank does this a lot with a lot of monetary policy instruments, which includes open market operation, bank rate, reserve ratio, moral suasion, and all that. Today we'll be talking on the open market operation, and when we talk about open market operation, we are simply referring to how the CBN manages government securities. That is the buying and selling of government securities in order to control the money supply in the economy, which include federal government bond, treasury bills, and all that. So because people tend to put more trust in government bond, treasury bills, because these are assets that are backed by the government. And because government is a going concern, it's not expected to collapse. So there is less risk in purchasing those assets. People feel so relaxed to put their money, their assets, their money, their liquidity in those assets because there is this assurance that as long as it comes from the government will always ensure the security of those assets. So they carry less risk when it comes to investment from the private sector. So today I want to quickly talk on open market operation. That is the treasury bills aspect of it, so that you understand the importance of it. Treasury bills. So anytime the government want to curb inflation, they want to reduce the amount of money in circulation through the CBN. So what the CBN does is to sell treasury bills, sells treasury bills. When they sell treasury bills, what's happened by implication is that the general public, the product is open to the general public that will bring in their money so that they can buy those things. So when you bring your money, so what the CBN is doing by implication is that they're able to mop up the fund in the economy back to the house. With that, there will be less pressure in the total money supply in the economy, and people can actually, so there will be less fund in the economy, which by implication should control inflation by all standard. And that's what CBN does in general. So anytime they want to boost the economy, they want to push more fund in the economy, what they do, instead of selling treasury bills, what they do on the other side is to buy back from the public. By so doing, they push fund into the economy. So it's vice versa. So if they buy from the economy, for instance, so if they try to sell treasury bills, automatically by standard, they drop the level of the interest rate in the economy, of course, will increase, and the lending rate will also drop. So by so doing, there will be less fund moving the economy. So they do it, it's a policy instrument that is used to control. However, for the general public, if you look at June 2023, the rate of treasury bills at that point in time was 9%, and the inflation at that point in time was 23%. What that means is that as the inflation grows, the rate too is expected to grow, because if the rate does not grow along with inflation, then the people of the public will be discouraged from investing their fund in treasury bills. So in June 2023, the annual treasury bill rate there was 9%, and the inflation was 23%. So by June 2024, the annual growth rate of inflation was 34.6% as of June, and the rate of the treasury bills interest rate is what? 20%. Now look at this. You could see that as inflation is growing, the rate is growing. That is what is expected to be. 20% is actually big enough for people to attract people into the investment. It is so big enough. But the challenge here is what is the inflation. So the inflation needs to must come down to encourage this to grow, because as long as the inflation keeps increasing, the investors in treasury bills we always lose confidence. Even though treasury bill is very secure because it's a government bond, people don't have too much of fear, anxiety to invest in it, or fear of losing their fund. But the problem here is that as long as inflation continues to grow, people will continue to lose interest in in investing in treasury bills. Because what it means is that the value of your money is eroding gradually. Because when you eventually sell your treasury bills, when you get your money in hand, inflation is already at 34%. Automatically, you're already losing funds. So the government must ensure that they control inflation so well so that they can encourage investors in treasury bills. What am I saying in essence? Treasury bills is very, very good. It's a